Hey guys, welcome back to another week of fundamental analysis. Very interesting week. I have gotten into a trade which we'll discuss about after the presentation, but let's start off with the 2nd of September to the 8th of September, fundamental analysis. So, COT reporting wise, we had some quite an interesting volume change in being out of the market for the US dollar and the US 30. We had an increase in oil volume change. However, you can see the bias has shifted to the short side. Silver also to the short side. Um, Pound and yen having a bullish surgence. So again, I'm not trading these currencies, but it's just good to sort of have a look at. I'm just going to keep, having a look at these markets. Maybe in the future I might be able to dabble in them, but for now we'll focus on our thing. So our thing right now is oil, gold, and US 30. Um, this volume change out of US 30, uh, might be something to consider because I do have a setup potentially on US 30, but with sentiment wise, you guys will see why I'm still happy to take a trade on US 30. Data wise, data point wise, we had services manufacturing PMIs, and we also had the big NFP JOLTS job openings and unemployment rates on Friday. So what we saw was we saw neutral data on ISM services and manufacturing, so sort of cancelled each other out. No real change in regards to that. For the Friday news, we had very big news. We had um, poor or cooler than expected employment change. So from $164,000 expected forecasted to 142. So quite a significant decrease from expected. Also a big decrease in terms of job openings from 8.09 million to 7.67 million. Both of them were also revised down. So just really poor data in terms of employment change and job openings. The average hours earnings, which I haven't put in this slide, was better than expected. But just considering this, we do have a shift in gold and oil to neutral based off my readings and my scoring. I don't really consider this accurate in the sense that you can see very heavy data towards employment numbers being, or labor market being cooler than expected, especially with the revision. So I'm not going to take this into consideration. You guys will see when I do the fundamental analysis with the economic news, it will make a bit more sense. But just touching based on inflation numbers will be next week, CPI and PPI, which is going to be huge for the market depending on what happens. Yeah, very, very interesting next week as well. This week's data. So what we had manufacturing PMI expected, manufacturing prices being higher than expected, but this is the main thing I'm looking at. We see GDP on the Aussie revised up, still 0.2. We see that jobs openings being cooler than expected, revised down as well. Moving down to unemployment being neutral, non-farm employment change being cooler than expected and revised down again. NFP being revised down, worse than expected. Average earnings being higher by 0.1 compared to forecasted 0.3, plus also double last month. And then unemployment rate being neutral. So you can see, I would say on a net negative or net cool bearish on the US dollar. The only thing that it really had was this average hours, but you can see revisions down and poor data essentially. So ISM Manufacturing Fior, which is who is the chair of the Institute of Supply Management, states that demand remains subdued as companies show an unwillingness to invest in capital and inventory due to current monetary policy and election uncertainty. So again, this is what I've written now is it's supporting that rate cut necessity based on cooler or poor labor market conditions. Jobs, the JOLTS jobs openings, same deal, lowest job rating since 2024, and revision down the month by 0.2 million. Again, supports poor labor market conditions and the need for rate cuts. yeah, the NFP, again, poor labor market conditions supports that rate cut narrative. Now, this two news here, the Williams and Wallace speaking are huge. They both spoke about uh, monetary policy and the balancing between inflation and the labour market conditions, and I've dedicated a full slide to this. So Williams, who's the president and chief executive officer, he did state that this is his personal opinion, that it's not the FOMC that's relating to it, but it still obviously holds precedent, being, he's the president and chief CEO of, the position he's in. So he states that disinflation has been supported in the data as well as expectations via the surveys that are taken. So the data points that showed disinflation and the monetary policy doing its thing was that the personal consumption expenditures, the PCE, fell from 40-year high of 7% in mid 2022 to now the 2.5% in July 2024. So that's from a data standpoint. From an expectation survey standpoint, the New York Fed surveys of consumer expectations, SCE, having expectations remain in their pre-COVID ranges in the recent months. So, we've got that real, inflation being controlled. Um, Again, next week with CPI and PPI, that will be just, I guess, a confirmation on that. But you can see Williams is supporting that inflation's sort of been controlled, and we're ready to sort of move on to the next step. So he states that supply and demand imbalances have dissipated, labour market conditions have eased, and inflation has come down significantly. His speech focused on two components: the inflation and labour market components, and he spoke about this word, where equipose, I think that's how you say it, equipose, which is the balancing of, the need to balance. So he stated accumulated evidence has increased my confidence that inflation is moving sustainably towards 2%, with the economy now in equipose and inflation on its path to 2%. It is now appropriate to dial down the degree of restrictiveness in stance of policy by reducing rates. So again, the thing that we're trying to paint, the picture that we're trying to paint, is that rate cuts are coming in September. It's almost 100% guaranteed, but the rate at which we cut, and that's where we're going to go with Waller, is the question right now. So Waller now states, I believe the balance of risk has shifted towards the employment side of our dual mandate, and that monetary policy needs to be adjusted accordingly. Again, supporting pretty much 100% that we're going to cut rates in September. While labour market conditions has clearly cooled based on the evidence I see, I do not believe the economy is in a recession or necessarily headed for one. And then Waller continues to speak on GDP being around 2.2% in the first year, retail sales being higher than expected in the last reading in July, and ISM services being quite strong. He does mention ISM manufacturing not being strong, but he obviously will highlight this picture of ISM services being strong. So basically very dovish. We're looking at that rate cut. The reason why I highlighted this second sentence, him speaking about the economy is not clearly headed to a recession in his personal view, is, although we might be, but in his view, this gives people it's a dovish sign. It's a good sign essentially. And the things that I'm trading, oil, gold, and US 30, it does sort of get affected by this statement. So if we're going purely based off this statement, gold isn't the idea of gold being bullish isn't really supported as much, because if we're not in that recession, if we're not in that panic mode, people are less likely to buy gold. On the flip side, if we're not in a recession, if we're not in panic mode, people want to invest their money, especially with rates cut coming. That's where indices, US 30, NAS, and the SPY will become more attractive. So now what I've got on the table is I've got the stocks on the table. And then also the economy is not in a recession, not headed to one. That basically supports the idea that we're still going to need oil. But I'm not feeling comfortable with trading oil. I haven't won a single oil trade. Right now, in terms of the fundamentals, they're slowing labor market conditions. I don't believe oil is a confident trade right now. So that's just something I wanted to highlight, something to, it's the things that you can read in between the lines that really might change your trading. And I think this will be definitely very interesting coming up next week. So the last thing I want to cap off is Waller does state determining the appropriate pace at which to reduce policy restrictiveness will be challenging. So again, we're just questioning how much basis points we're going to cut by. So the next slide is the expectation on the 18th of September. We're still, at least from this FedWatch tool, we're still 70% for the 50 basis points. So, again, just something to note, something to look out for, until come 18th of September. So I'm going to keep looking at this FedWatch tool to see if there's any changes week to week. Next week's data. So, concentrating on what we need to. CPI is going to be the biggest, and PPI. So the inflation data points we can sort of rely on. I'll be very surprised to see if this is higher than expected. That concept of stagflation still at play, so that supports my gold move. It sort of doesn't support my US 30 sort of ideas, but yeah, we can't control this. We're just going to have a look, change our biases if we need to, and trade accordingly with risk management. Also, University of Michigan inflation expectations, because again, this whole week is we're thinking about inflation as the main concept that might shake the market. Take home. So I am still pretty much with this stance, and that stance is rate cuts confirmed for September, bullish for gold, labor market conditions being the focus, gold as the ultimate safe haven, still very much so. Still very bullish gold, and we're actually in a gold trade, so we'll go through that. Now oil, what I've written is I'm no longer happy to trade oil as a main contributor for inflation and slowing labor markets. So oil, if inflation's higher, oil is a commodity. It's being used, unlike gold, which doesn't get used. Oil does get used, so it is part of inflation. And with inflation coming down, at least from the data points we have, and with the slowing labor market conditions, meaning oil isn't going to be used, I'm not happy to trade oil at this period. Might be for a little bit actually. Now US 30. I'm still bullish on US 30, especially with rate cuts, and especially with Waller again stating that he doesn't believe the economy is in recession or headed that way. So if Waller doesn't believe, and again this is all expectations, it's not actually what the market is doing, it's what people think the market's doing. And if Waller and if he can convince the public that he doesn't believe the economy is in a recession, we're going to get rate cuts, things are going to be better, well, if money is circulating, then people want to invest in US 30. That's my index of choice. I am bullish US 30. So US 30, the only thing that we had on the back end that I didn't like was the COT report with the volume going out. But again, fundamentally, it's sound, and I'm going to test my luck and trade US 30. So let's go to the charts. We are no longer trading oil. We'll take that off completely. We'll just look at what oil's doing. You can see oil right now is in a very nice support zone, but like I said, I'm not happy trading it. It could bounce up or it could bounce down, and I'm not happy to trade that. I'm not confident. Now you guys probably want to see my gold trade. I am in a gold trade, right? Got in on a 4-hour candle. This was so this was after New York, or towards the close of New York. We see that obviously this is a big rejection week here, very nice hammer there. We come back, we have another rejection week. I was like, okay, let's test. Oh, actually no, I was asleep then, so I couldn't have entered then anyways. But then we saw this print here, and basically, if we want to take a look from a technical point of view, that's a double bottom. But yeah, I just like the rejection wick. I like this zone here. I like this area. We have put our stops nice nice wide stop loss under these lows here. And then yeah, we're just gonna let it do its thing. I'll widen that out, pop this a bit closer. We'll let it do its thing, go back on the daily chart. So what I'm gonna look at is, and especially with that news on Friday, you can see it pumped up on Friday and then came back down. So we're sort of ranging in between here with gold. Gold might take us out and then head higher. Could probably do that, or it could also just do that. So we let price do its thing, right? This is from a fundamental standpoint, gold is very supported. We are, if we go on the weekly chart, we are headed up in an uptrend for gold. We're at all-time highs. I don't care if we're at all-time highs in terms of it retracing, because like I said, from a fundamental point of view, we have rate cuts coming in September. We have cooling labor market conditions and unemployment, which people want to start to put their money into safe havens as a result. And from a technical standpoint, it's looking beautiful. So in that trade, now US 30, let's have a look at US 30 because I like this trade a lot. Again, we're at sort of all-time, yeah, we are at all-time highs for US 30. We're coming down, big candle coming down. We have this beautiful daily spot here, which we've marked up with an alert. I'll pop this a bit higher here, and basically let's see what percent we came down. If we're coming down here, that's 3%, around 4% down here. That's a good retracement. We might actually even just do this. If 4%'s down there, we might actually put our alert there. Yeah, so around that 4% mark here, which is a nice retracement for the US 30 or any indices in general. So you can see from a technical standpoint, it's beautiful. What I want to see is, obviously, I want to see the price come down, head up that way, like that. Okay, if it just tanks down here, then we might look at this support zone down here, or potentially even one down here. I think this one makes more sense actually. So being close, we'll leave that there. But I think if price was to seek liquidity, it'll come down here. It's a better zone anyways. So we've got nice zones marked up, very nice zones marked up. Yeah, ideally we're going to definitely get in a trade here if we've got the signal to. But like I said, we're already in gold. I have started to increase my risk, so I popped 0.07 on the position size for gold, which is around 200 USD. So we'll let that do its thing. And yeah, that's me for the week, guys. I will see you guys next week.